At the recent Jackson Hole conference, Federal Reserve Chairman Powell said that they have a dual mandate to promote maximum stability and to maximize employment. Those are the two goals. So what does this mean for you? Let's talk about it. The one hammer that the Fed uses to slow down growth is increasing interest rates. Officials have hiked rates 5 times since March, and there's talk of 2 more big increases by the end of the year. Needless to say, the Federal Reserve has become increasingly aggressive when it comes to increasing rates. There's widespread confirmation that the US economy is already in recession. It's defined by 2 concurrent quarters of negative growth. And economists have also confirmed that both Europe and China are effectively in recessions as well. So think of it as a global recession. We're also getting many indicators that pricing on everything else is coming down, consumer goods, and that's building materials, daily essentials that people use every day, even real estate. And I think the notion that inflation is something that everybody needs to be worried about may be looking at it the wrong way. I really believe that deflation is largely ignored, and this is where the price stability portion comes in, meaning that if pricing is coming down, it's getting handled. I don't think that deflation is necessarily a bad thing. In general, deflation can be good if it's caused by technology or progress, and I think we're going to see a lot more of that over the coming years. But right now, we're looking at bad deflation in terms of a general slowdown in spending, consumer spending. The Fed is out of its quiet period, and the Fed governors have been whispering another 75 basis point hike next month. They will probably need to rethink this over the next few weeks as the pricing of goods continues to come down and earnings reports from companies have started to slide downwards as well, because we are in a recession after all. Then the Fed needs to also consider the markets. The S&P is down 20% year to date. The NASDAQ's down 30%. The stock market has not seen a worse year since 1962, and that was when the Cuban Missile Crisis took place. When it comes to bonds, it's been the worst year of performance in anyone's lifetime. It's like 250 years. 1788 was really the last time, and it's been very rough market for investors that invest in stocks and bonds. Then there's a second part, employment. I think that there's been some labor hoarding, is what I like to call it. The employment numbers have looked strong, and there's still help wanted signs everywhere. In actuality, employment has been essentially flat over the past 4 to 5 months. Many companies couldn't get labor during the supply shock and, of course, during COVID, so businesses are holding on to people probably a little longer than they would have held on to them. I'd be surprised if unemployment gets all the way to 6% at this point. But I think that the Fed is getting a lot of signals that ultimately end up lagging the indicators, the PPI, the Producer Price Index, and the CPI, the Consumer Price Index. Once the Fed considers this data, along with earnings from companies that are, in terms of things just sliding downwards in terms of profits, they may hold off on another increase. That's how I think it's going to end up. Regardless, as investors, that if you're watching right now, you're probably an investor too, you have to prepare for what's ahead. While there may not be an increase in terms of rates, the effectiveness, the effects of current economics climate will be around for a very long time. The current focus needs to be on cash flow and building wealth. And the right real estate can do both. And I'm not talking about doing flips. I'm not talking about buying a low cap deal somewhere else or using bridge financing or anything else like that. I'm talking about getting in on good, solid, cash flowing deals where you can build steady, predictable monthly income no matter what happens. And also by investing in multifamily housing in select areas that are still very strong for growth. Anyway, what do you think? Are you still bullish on stocks, or are you all in on real estate? Let me know in the comments, all right? Talk to you soon.